Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 20th of November. I'm Daniel Lam, your host for the podcast. After our discussion on Europe in yesterday's podcast, I want to take a look at the potential policy responses from China. So far, Trump's cabinet build-out has been quite hawkish against China, but we do not expect an overly aggressive response from the Chinese authorities. In fact, we believe China is likely to be stimulating at its own pace and responding accordingly to the moves that the Americans is making. China's potential response is likely to be more inward-looking, boosting domestic demand and forging greater economic and supply chain integration with the rest of the world. China's response to the last trade war was to expand into more markets, and the increase of market shares in the emerging market more than offset the losses from developed market, mainly the US. The increase of Chinese exports from 2018 to 2023 exceeded the combined increase of exports by the key China plus one countries. So to put some numbers into this, China's total export as percentage of world total rose from 16% to 20% from the start of Trump 1.0 to now, while its total export to DM as percentage of DM total imports fell from 13% to 12% in the same period. And we believe this model of increasing its export to EM is likely to continue. But given the aggressive stance from Trump this time, China will likely need to leverage more on its domestic market in order to offset the potential loss of external demand. Now, I was quite surprised to see that net exports became a much larger contribution to Chinese growth post the last trade war, while consumption's contribution actually declined. Hence, it is quite reasonable to assume that China is likely to revert to its dual circulation plan that was first introduced in 2020, i.e. using proceeds earned from export and circulate that back to the domestic economy and create value there. Now let's talk about FX. While it remains an important contributor to China's export competitiveness, its role has declined. Chinese competitiveness is increasingly driven by industrial upgrades and localization of supply chains, evidenced by a decline in contribution to export price from FX and the development of China's bilateral trade balance with key manufacturing countries. So taking all these into account, we do not believe in aggressive moves in the dollar CNH. Our 12-month target is at 7.3. As for Chinese equities, the Hang Seng Index is towards the higher end of our bear range, between 18,000 to 20,000. But there are signs of stabilization. For example, the relative strength indicator, i.e. the RSI, that is recovering, while the index is moving sideways. This is showing diminishing selling strength and paves the way for the index to recover to our base case range, which is between 20,000 to 22,500. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.